Hello viewers, we'll be going over the S&P 500, ticker symbol SPY. In this video, we'll be going over the day-by-day probability model, the technical performance of each model, how we find the models, comparing the current trend with the trend in the past, and we'll go over the day-by-day forecast for the S&P 500. So back to the technical analysis, we're currently down 85 basis points on the 1-hour chart. We're in negative MACD. However, we see a slight convergence in play. And if we expand that further onto the 4-hour chart, we have now approached to negative MACD and we have not reached oversold RSI yet. And the next possible support will be the 100 moving average, this orange line, that is around a price of $319. If we expand out further onto the daily chart, what we have here is we start to see a divergence on the daily MACD. We were quite near overbought RSI, but we have not quite reached that level yet. And at the moment, the next support on daily chart will be the 18-day moving average. And we had previous support, or I should say resistance, around that range. And since we're above resistance, that now acts as our immediate support. And around that range, that is around the price of $318.21. So that will be our first immediate support. And that coincides with previous levels where we gapped down from June 10th to June 11th, and previous resistance around the price of $13 or $318, and resistance that dated back to July 13th. So now let's examine the day-by-day probability model. These models are available in the link below, so do check it out. As we progress to the 5th day or week of trading, we have a 20% chance for it to climb between 0 to 2% and a 20% chance for it to climb 2% to 4%. And to the downside, we have a 20% chance for it to fall between 0 to negative 2% and a 40% chance for it to fall between negative 2% to negative 4%. So now let's examine the day-by-day forecast for the S&P 500. So we have 1 day out, that will be a Monday, and 2 days out will be a Tuesday, and so on. So we have 3 days out, 4 days out, 5 days out. Which one of these models we should focus on? Ideally, the model that is best matched to the current trend. The blue lines are current trend, and the line overlapping it happens to be the best match. Right here we have our current trend, and the trend below is that we found on the line graph above, and this trend dates back to October 12th, 2001 to January 9, 2002. So let's begin comparing both the trends. We start averaging above the middle Bollinger Band, and we ended at above the middle Bollinger Band. So what we have is 1, 2, 3, 4, 5 points. And on the trend in question, we also started above the middle Bollinger Band and ended above the middle Bollinger Band. And we also have 1, 2, 3, 4, 5 points. So there's reason to believe that the trends and patterns are somewhat the same. The outcome and forecast should be fairly the same. So the model that we just examined was October 12, 2001 to January 9, 2002. Back then, the S&P 500 continued to fall around 2.5%. If we head back to the day-by-day probability model, that coincides with the standard deviation, 40% chance to fall between negative 2% to negative 4%. If we examine closer on the technical performance, on the current trend that we're in, we're down 1% from monthly high, up 13% from monthly low, up 46 basis points from 10 simple moving average, up 2% from 20-day simple moving average, and up 4.5% from 50-day simple moving average. Compare that to the trend that we just found. Back then it was down 2% from monthly high, up 8% from monthly low, down 40 basis points from 10 simple moving average, up 36 basis points from 20-day simple moving average, and up 1.4% from 50-day simple moving average. There are technical differences. One is the 10 simple moving average, so do take that in consideration. Again, these models are available in the link below, so do check it out. If you enjoyed this content, feel free to like, comment, subscribe, and thank you for watching.